Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to talk about what are non-qualified annuities, talk about the taxes, liquidity, and payouts. And we'll also answer some common questions that we get from our clients when they're inquiring about annuities. So getting to the point, what is a non-qualified annuity? A non-qualified annuity is an annuity funded with after-tax money. So not from an IRA or a 401k or retirement account. It grows tax deferred and is commonly used for future income or protected growth. There's really two common scenarios where we get a non-qualified annuity. Either you're funding it with cash or you're funding the annuity from a life insurance policy, permanent life insurance policy that you own, and you're transferring over the cash value, or you own a non-qualified annuity already and you're transferring it over to a new non-qualified annuity. Let's see, you invest money you've already paid taxes on, the annuity grows without current taxes, and you only pay taxes when you take the money out. Is a non-qualified annuity taxable? Yes, but only the gains are taxable, not your original investment, the principal. Tax treatment is different, and it's with non-qualified annuities. And the way that you take the income or withdrawal from the annuity determines how it is taxed. So I'll go over the two methods. Okay, so when you take out money from an annuity, a non-qualified annuity, you have two options. You have what's called categorized as a withdrawal, and that is a penalty-free withdrawal, systematic withdrawals, or doing lifetime withdrawals through an income rider. Anytime that you're going to the insurance company and saying, hey, I want to pull some money out, or hey, I want to start a lifetime income with my lifetime income rider, that is considered a withdrawal. And then the other version is annuitization. And annuitization is you're telling the insurance company, hey, insurance company, I give up all control over my money and I want you to convert this into an irrevocable stream of income. The word irrevocable means once you start that distribution, there's no turning back. There's no changing your mind. Your money is now the insurance company's money, and you're just getting this paycheck on a fixed frequency for a fixed period of time or for the rest of your life. Okay, so now that we got the two categories of how income comes out of an annuity for a non-qualified annuity, withdrawals. So penalty-free withdrawals, systematic withdrawals, lifetime withdrawals to an income rider, those are taxed by the LIFO method, last in, first out. And what that means is the tax-deferred portion, so the portion of your annuity that hasn't been taxed yet, your gains, come out first. And they continue to come out first, and you're taxed on all those withdrawals. Until you get into the principal. Once you get through all your gains, then the money that is in the non-qualified annuity contract it ceases to be taxable. Okay, so for example, let's say you got $100,000 in a non-qualified annuity. $50,000 of it is after-tax money. That's your principal, and then $50,000 of it is gains. You start taking withdrawals until you eat through that $50,000 of taxable gains. You're going to pay ordinary income tax on all of those withdrawals until you start tapping into that original after-tax $50,000. Okay, so last in, first out. If you annuitize, it's a little different. Use the same example. You got $100,000, $50,000 is after-tax money. The other $50,000 is taxable gains, and you annuitize it. What the insurance company will do is called a exclusion ratio, and it's a ratio in your paycheck that you receive from the annuitization of taxable income and not taxable income. So in the case of a $100,000 non-qualified annuity where it's 50-50 split, your paycheck, let's call it $1,000 a month, $500 of that $1,000 is going to be taxed. The other $500 is not going to be taxed. Going into early withdrawal penalties. Okay, so annuities, for the most part, follow similar or the same rules as the IRS in withdrawing money before retirement age per the IRS, which is age 59 and a half. Okay. If you take a withdrawal from a non-qualified annuity, this is a withdrawal, not a annuitized distribution, you're going to be subject to a 10% IRS penalty on the gains only. So going back to the $100,000 example, you take out $10,000 and you're 56 years old, you're going to be taxed 10% on all $10,000 because it's coming out LIFO. So you're going to pay ordinary income tax, state and federal, and then you're going to pay a 10% IRS penalty on top of it. Okay. If you did the annuitization distribution where it's exclusion ratio, in the example of $1,000 a month, 500 being taxed, 500 being not taxed, 500 that is being taxed will get a 10% IRS penalty on the gains only plus ordinary income tax. There's a couple of ways you can get around this 10% IRS penalty. Two methods at the top of my head is a 72Q, which is a fixed payment dictated by the IRS that allows you to take a equal distribution for 5 years or age 59 and a half, whichever comes, listen for it, later. Not first, not whichever comes first, whichever comes later. So if you're 58 and you choose a 72Q distribution, you got to go for the full 5 years, okay? Not until 59 and a half, okay? If you're age 50 and you do that, you have to take the 72Q until age 59 and a half. Otherwise, you're subject to that early withdrawal payment. Keep moving on. Any other questions that we have? Why people use non-qualified annuities, tax deferral, no yearly taxes like brokerage accounts, principal protection in most cases, fixed annuities and fixed index annuities provide a principal protection, lifetime income like a pension, no contribution limits. That's cool for the wealthy folks out there. If you've maxed out your retirement accounts and you really like that pension idea of contractually guaranteeing your income up to 30 years in the future, and you want to contribute the hell out of something, you can do that with a non-qualified annuity. Some areas where they fall short, gains are taxed higher than capital gains. There's no step up in basis. So when you die, heirs will owe taxes on the gains. They typically have to get that withdrawn over a 10-year period. Liquidity restrictions, I mean, there's surrender periods with any annuity out there. Other than that, I think that covers most of what a non-qualified annuity is. I think the only thing that I'd mention is, well, what's the difference between a non-qualified annuity and a qualified annuity? Briefly, a qualified annuity is just your IRA. You know, if you have an IRA annuity, that's a qualified annuity. If you're rolling over funds from a 401k, 403b, 457b, TSP, et cetera, over to an IRA annuity, that's a qualified annuity, and those are taxed differently and have different rules. Hope that answered your question today off the cuff. If you do have specific questions, go to your favorite search engine, type in the Annuity Expert, and give us a call at 770-755-1565. And we'll be more than happy to answer any questions about your non-qualified annuity. No charge to you and no obligation as well. Like, subscribe, and we'll catch you on the next video. Thanks. Have a great day.